Today, we're going to learn a new strategy, and it's called a 0 DTE strategy. 0 DTE. What is 0 DTE, you might ask? Well, 0 DTE means 0 days till expiration options. And there's a lot of really cool things about 0 days to expiration options. So the first thing is I'm just going to explain what it is. It's an option that expires on the same day that you trade it. So there's 0 days to expiration. So right now it's January 3rd. When we take the option trade, it will expire on January 3rd. And one of the great advantages for this is that you get some very low prices if you're buying and selling calls, or if you're buying and selling puts. The prices are extremely low. So you can get into very large leverage positions for a low price. It's also very helpful because you can get spreads. You can do option spreads and they close right away, so you can collect that premium. You don't have to wait a week, a month, or 2 weeks to collect the premium. So we're going to do a 0 DTE strategy today. I'm going to show you exactly how to do it, and then we're going to do a spread, and we're going to collect the premium. Now, there are some additional risks on this. Let me first just go ahead and we'll just start jumping in to the chart here, and I want to show you what it actually looks like. So here is the S&P. You can only do this on a few things. You can do it on the S&P. You can do it on some other stuff. And unfortunately, I missed a great trade. It was pushing right up here at 470. I was going to sell at 470, but I was getting all my software set up and all that good stuff, and I just didn't get a chance to do it. But right now, we're getting a pullback. So what I'm going to do is I'm looking at the chart right here, and what you want to look at is that where is price going for today, because it's a one-day strategy. So this is a 1 hour chart basically, and I need to know where price is going to go. It opened, where did it open? It opened like down here, then it went up, or it opened here, went up, and then now it's headed lower. So I'm believing that we're going to be lower. So I believe that we're going to close below 470 today. So that's where I'm going to trade. So now if we close below 470, I'm going to look at the options. So I'm going into Robinhood here, and I'm looking at my spreads, and I can see that I have calls. You can do call or put in Robinhood, but we're going to do calls. Okay. And so what we're going to do is we believe that price is going to close above 470. So we're going to buy a call, or we'll buy a call at 470. Okay. We're going to, let's go to buy. There we go. Buy a call at 470. Okay. Wait, actually because it's a spread, I'm going to buy, you just do it one. Let me first explain what I'm doing here. You buy a call and you sell a call. That's what I'm doing. I'm going to buy and sell. So I'm going to buy the 470 and I'm going to sell the 469. Okay. And if price is below 470, I get to keep all of the credit. Okay. So I'm going to buy at 67 and I'm going to sell at 114. Okay. That's how it's going to work. Or I could do it. I could, buy the 471 and sell the 470. That's going to be a little bit safer. Or wait, I need to make sure I get a positive credit though. So I'm going to buy the 471 and sell the 470. So I'm going to buy this one and sell this one. And you might ask why we're going to do that. Well, I'm going to explain why we do it this way. The reason we do it this way, because if I buy this, it's going to cost me, if I just want to sell this, it's going to cost me a lot of premium. So let's just sell it. And we're going to collect the credit here. And it'll show you what's it going to cost, right? So we're going to review the order, and it says the max cost is $37, but it's actually going to cost much more than that. And so what we want to do is we want to buy and sell to make it even cheaper. Okay. So we're going to go ahead and we're just going to adjust this. I bought that one, and now we go over to the sell, and we're going to sell this one. Okay, so now I get a $30 credit, and I have to put up $100. So the max on this trade is going to be $100, and my credit is 30. Okay. And so now it's dropping a little bit. But what we want to do is, if I want to increase my size here, let's go back and we can bump it up, and we can do 10 of these. Okay. 10 of them. And it's going to, now I get $299, and I'll know if I win this at the end of the day or not. So it's $1,000 of collateral at $309. So I'm just going to submit this order. Let's go back and look at the chart one more time. Okay, it's actually crashing pretty hard. I'm going to submit this order, and we're going to see what happens. Okay, we're going to submit it, and there we go. The order just got partially filled, and so I got $299 in credit, and I got 2 positions so far. And so now, as long as price stays below 470, and it looks like I only filled 2, and that's okay. Oh, we just got them all now. So there we go. I got my $300 in credit, and as long as it stays below 470, I'm going to be fine. Now, of course, I could close it early too. You know, if the price drops and it goes down to 467 or something like that, I can close it, or I can just let it expire. Okay, so that is the 0-day trading strategy. There's a lot of other ways to do 0-day trading strategies as well. You could just buy straight up calls, and if you believe the price is going to go up, or you could buy puts if you believe price is going up or going down, right? So if you're like, okay, it's going to close below 470, I'm just going to buy a put right here, and as it drops, your value of your put goes up, because you can see 128, 197, 281, 372. As the price goes down, as you go down in price, the put goes up. Okay, so that's what we do with these 0-day trading options. And the great thing about it is, you know, you could make really good revenue. Now, if you're buying one of these, just beware, it will expire today. So it can change in price really fast. It will change in price really fast. So you've got to be, if you're just buying and selling calls or buying and selling puts, you've got to remember, take your profit quickly, because it'll expire fast. Now, if you buy it in the money, you know, you're going to buy a put here in the money. Well, then you're going to be able to collect that at the end of the day. You'll be able to collect that stock. So, very interesting form of trading. It's a new style, and it's only available on a very select few things. It's available on the SPY, the QQQ. Those are the 2 main ones that you can do this on. And it's a great way if you want to collect a little bit of money every day, right? Now, like, for example, I just collected a $300 credit. Now, the one thing let's go ahead and look at that trade now. We're going to go look and see how my trade is doing. The one thing you got to remember, though, is it was, you know, I risked $1,000 to make 300. So if I'm wrong, it's not a great winning percentage, right? It's not a big winner. But you can do this so that you're really at a high winning percentage, you're making a lot of money, and you're picking great trades. So let's take a look actually at my position. I got in at my credit was 29. So right now, looks like I'm down a little bit, just a little bit here, because my average credit was 30, and now it's 32. So if price goes down, I'll be good. And even if it stays below the 470 mark, let's go look at the chart. So, you know, we're still below, we're still doing good. As long as it stays there, I'll be fine. And it'll be a great trade. So let me know in the comments what you think about 0 DTE strategy. Do you want me to dive in on this topic a little bit more? Is this something that you're interested in? Let me know in the comments what you think about 0 DTE options. And if there's any other strategies or anything at all that you're interested in, just let me know. All right. See you in the next video.